Smiles, okay.
Because we just bought a house.
Because you just bought a new house that's really cheap. Yeah. Yay. Okay, so this is you guys, and this is your house that you're buying in traditional financing world, okay? So when you're buying a house, what are they looking for to qualify for your loan? What do you need?
Stability.
But what do they need? What are the specific things?
Income.
Credit. Okay, so you need good credit. Who is good credit about? It's about you, right? So that's personal, right? Okay, what else do they want to see? You said income. So they want to see that you've been in the same job or the same type of job for 2 years making a similar amount of income, right? Which is also personal. Yeah, okay. So they want to see your income. What else do they want to see?
Assets.
Assets. So they want to see that you have some assets and that you have the ability to cover this loan if something were to happen. So they want to see your assets. And then the other thing that they mainly want to see when you get a loan is what?
Down payment.
Reserve. Well, the down payment as well. However, yeah, your down payment is part of your assets. And those assets need to be seasoned. Because they want to see that it's personal, that it's your money. So then you go down to the reserve account. They want to see 3 to 6 months of reserves, right? So all of those things would be about the two of you, right? Your credit worthiness as people. Does it really have a lot to do with the house? I mean, if it appraises for at least 80% of, whatever, if it appraises for at least the value and you're lending 80%, whatever their guidelines are, that's really all that matters, is that it appraises. Are they concerned with when you're going to sell it? I mean, if you have a prepayment penalty in the loan, but really, there's no attachment, Are they attached to your profits or what the house sells for? Really, only that they get covered, right? They have no interest in it. Their interest isn't in the house, it's in you, right? So that's traditional lending. Like, that's what's happening today. Do we all know what happened, though? So what happened is, there's another business out there for buying properties. It's actually a great thing to use if you short sell your house and don't have credit. It's called hard money. So if you've got the two of you over here, you're still happy.
Less hair.
Still happy. Oh, no, still good hair. Maybe some more volume. Okay, good. Okay, so over here, when you're using hard money, and for those of you who hadn't, or you can say the same thing as getting a business loan. Like when you go to get a business loan, what are they looking at? Your business plan, right?
Right.
They're looking at the profitability of the company. They're looking at all of these things when you're getting that type of money or if someone's investing into it, right? So that's what hard money is. Investor loans are, angel loans, whatever you want to call them. So over here, when you're doing that with the house, so when they're doing it with real estate, the house is the business, right? So what are they looking at?
And value.
The value, right? They're looking at what the profit is, right? Because they want to know, is there going to be a profit in this? Because if they didn't pay for so many months and then I got the property back, what's the profit, right? That's what they're looking at. They're investing in it, banking either on you paying it back and then making a short-term profit. Because this over here, this is long-term, right? Right? This is long-term. This, hard money, 6 months, right? That's a short-term transaction. So the rules, they don't follow all the rules. They're not FDIC insured. Do you know what I mean? It's a completely different. They're not insured because what they do is risky. Because what if that person trashes the property and it's not worth as much? You always have that risk, right? So, do they care about the credit over here? Mm-mm. Income? No. Assets? That's the only one that they have anything that they can do, because this is also non-recourse, right? Which that's going to get to a point. So remember that. This is a non-recourse debt. So if you get hard money and you screw up, they can only take the property. They can't come after you personally. That's how it works. And then the reserves. Do they care about reserves? No, because usually they build the reserves into the hard money loan. They don't care if you have the money or not, because it's the deal. So this is what happened from 2003, right, to 2007 about. Yeah? We were doing this long-term product called FDIC insured banks doing mortgages that way. It was a business. They were giving you loans based on the appreciation of the house, not on your ability to borrow. How do we know that? Because a bunch of people who couldn't borrow got houses because they're foreclosing based on the results. The market crashed. Why? Because it couldn't be sustained. They were not investing in your ability to pay a loan. They were investing in a business deal. Capitalizing on, well, if you can't pay, I could just sell the property and make a profit anyways, which is playing over here. This doesn't belong with FDIC. This doesn't belong with any of that. This is more of a private, like you wouldn't insure a fix and flip company with FDIC, right? You know, it's the same type of thing. Yet we're all still holding on to it and being held to this. So real estate, yeah, we all screwed up. It's a long-term thing, and we all wanted to act like it was short-term and we were all professionals, okay? But we were also set up for it, right? Because you need to buy a house now, they're going to go up, da-da-da-da-da-da-da. It was the perfect storm. Let's have people totally irresponsible, give them all the money in the world, give them granite countertops, give them everything. They'll completely go for it. And we did, okay? So whatever, all of us did. The rich, the poor, everybody in between. So what? We screwed up. We have a housing market that's in, that's in the tank, that's completely tanked, and we needed it too. Because we all needed a giant reality check. Yeah, I mean, even though it kind of, is difficult what's going on, doesn't it feel kind of good to, like, be a little bit more responsible about things and be like, hey, whoa, what did I get wrapped up in, man? Did I really need to have, 8,000 square feet? Did I really need that, like, highest grade of travertine that I really don't even understand what it is, but it was the most expensive one and it made me feel good? We didn't need those things, but we did it anyways, okay? So, understanding, though, so did they. Because at the same time, take your house and multiply it times 20, and that's their houses, okay? So they did the same thing. However, like I mentioned earlier, this is non-recourse, right? And this is my biggest fight on why I think it's BS that they want any money out of people for short sales. Everyone got into a business deal. You don't get to go after the person personally. You get the house. That's your collateral. You treated it like collateral. You treated it like a hard money deal. They treated it like a hard money deal. When you take away everything personal, it's no longer a personal loan. How is a loan where your credit score is in the, complete dump, they haven't verified any income, assets, or any money based on anything personal about you? It's not. You're not putting any money down. That's totally based on the deal. Yet people are still holding on like they're personally responsible. So that's what's going on. They've completely got rid of us. That's why they did all the bailouts and did all the FDIC things. Let's clean up the bad deals. Because in business, who here has ever been an independent or been in business in any sort of way? If something didn't, well, if you were in business, if you didn't make any money for 2 years and just continued to lose it, you'd probably get out of the business, right? Or 3 years. So welcome to your house. Okay, so it's a bad business. And Americans don't even realize that they're in this business called their house that we're still paying for and running. Meanwhile, they're already paid like it's going to fail because that's what they've expected, because that's what the system's set up. So just understand that's what's actually happening. It isn't a personal loan. That way they never were personal loans. That's why it's so messed up. They were playing a very dangerous and lucrative private game with money that's not supposed to be managed that way. You look at it now, that's crazy, right? However, that's what happened. A bunch of hard money loans using not hard money institutions. So that's how we somewhat got to that situation. Hopefully that makes it make a little bit more sense. So